Peter Bros, Longwood Currency Trading. It's middle of October of 2021. How do you develop consistency in your Forex trading? Now you can have 5 years of trading experience and be profitable, but that doesn't necessarily mean that you're consistent. And if you're not consistent, then the probability of a major disaster hitting and potentially bringing your account to the wood is very high. And I'm speaking in terms of probability analysis. I've got a degree in physics, a lot of math behind me. I've been a real estate investor for 40 years, computer software developer. So I sort of understand what's possible and probable and all that other kind of stuff. And I've been involved in the currency markets since 2007. Actively trading them since 2012, and have had my fair share of problems. And one of those problems was nobody ever talked to me about being consistent. Consistency was something that was assumed that you would be once you did steps A, B, C, and D. But it wasn't really emphasized that the reason that you were doing steps A, B, C, and D was to get consistent. Those steps were simply provided as stuff that you needed to learn in order to get the ball across the goal line, which was to make a trade and get out profitably. But that's just information. But the ordering of that information is so very, very critical in order to understand not only how to be successful in trading, but how to be consistent. Because you can be profitable but not successful, as far as I'm concerned. Because I've been there. I've been very inconsistent in the way that I trade, and I know what happens as a result of that. I get lucky for a while, and then boom, away goes the account to a certain high percentage degree. You know, I stumbled into a trade the other day I got into, and I was not consistent in the application of my rules. I set some limit orders. The limit orders got hit while I was out having dinner, and boom, I come back in and I'm 30 pips out. So that's not within the methodology that I have. Now, I was entering those trades with those orders with the intent to do carry trades and to probably be a certain amount underwater because there were many factors in considering the structure surrounding my entry point, such that I realized that it was basically jump ball as to whether we'd go in some retracement stuff before we went through the area where I was. I guess basically I had too much confidence in what I thought was going to happen that I took the trade in a jump ball situation. And instead of waiting for it, I did the typical anticipatory trade that I tell everybody not to do. But it's that failure in the consistency that has me now in a carry trade, which I don't, that's not part of my methodology. That's a whole separate thing that I only do in certain conditions, and the conditions that we're in right now warrant for the larger wins to take a longer term view. I closed out last week. I closed out a $720 or $760 day, and then I had a few days before that was a $1,300 day. But I had been in that trade for 4 or 5 days, and then there was a big one before that. So that those were all longer terms to take advantage of these conditions that the market is in. Where if you tried to do the short-term trading, you'd have to sit back on a daily basis and just kind of, the entry, I guess, positions that I am consistently successful with were not being manifest on that daily type of a basis, so that I shifted my thought process to the higher time frame, so that number one, I wouldn't have to trade so many times during the day. I don't want to scalp it, and work off on the longer time frame. But the price that you pay for that by not being consistent with your trading is that instead of making $700 or $500 or whatever it is for the day, I'm now a couple of days, 2 days into it, and it's about, I don't know, $1,000 against me. Slowly turning. I mean, it's been in my favor a little bit. It goes a little bit against me. It goes way in my favor. It goes way against me. All within the parameters that I'm trading in. So I'm trying to map that, my framework for longer term trading, from my short-term consistency methodologies, map that up into the longer-term environments. And it's difficult to do because I feel that those environments tend to be more unstable than they are stable at the shorter time frames, and there are a lot of reasons for that. But if you're learning to trade, or you have experience in trading, and you're bopping back and forth between short and long-term trades, between currency pairs, between what you think is a good entry from a pass entry. I don't know what all you're doing. But if you don't have consistency in your trading, then what can I tell you? How do you know if you're consistent in the trading? Well, there's a little equation, and it is one of the most important equations in currency trading, and that's your win-to-loss ratio. And that's developed over at least 100 trades, and I prefer to have that over about 300 trades, because as you start looking at what you're doing, that first 100 trades or the first 50 trades is just crap, because you haven't developed the methodology that causes you to win enough times until you've had enough times to fail to figure out what not to do, right? And so when somebody asks me, well, how many times do I have to make trades in order to get the metrics that you're talking about? 300. It's like, just do them 300 trades. That's a lot of trades, particularly if you're trading long term. You trade now on the daily chart, you might trade once every 4 or 5 days. 300 times 5 days, that's a long time to get that type of metric. Now, do you need 300 trades as a long-term trader? No. 100 would probably do it. Maybe even 50. Because the time of the trade slows down, so do the number of times that you need to fail, because there are only so many number of ways that you can fail when you're in a long-term trade. It makes it really simple. The problem is achieving the longer-term goals that you have for a position, as opposed to the short-term trader. I go in, it doesn't go in my favor, boom, I'm out, next. Go in, it doesn't go against me, boom, I'm out. I go in again, and it goes beyond my profit target, and I get a 2 or 3 times back from what my short stops have given me. That's my consistency. So when you're looking at talking about consistency, how do I know that I'm a consistent trader? It's that when you have a consistent win-to-loss ratio over 2, hopefully 3 significant sample sizes of trades, and that those win-to-loss ratios match up. That's when you know that you're successful. So as a day trader, I usually do a couple of positions a day, and I don't trade every day, so I average maybe 3 days a week actually having a position on, because if there's no viable trade entry, I'm not going to sit there for 2 hours waiting for something to happen. I'm just going to go get a cup of coffee and call it a day. So that happens a lot of times. I don't trade. So still in trading 2 or 3 times, or sometimes I'll trade 7 or 8 times. I'll be in there scalping away, banging away, because I'm in a chop instead of some kind of a trend where I can be a little bit more predictable in the number of times I'm going to be entering a position. And so getting through 50 or 60 trades is not a long period of time. And so once I feel that I understand my rules and that I'm applying my rules in a consistent manner, as reflected in that I'm making money consistently within the parameters of where I think I need to make that money, then I can start the clock and run out 20 trades or 40 trades or whatever they are using that exact methodology. Calculate a win-to-loss ratio on that set. Then take another 20 trades or 50 trades and do the same thing. Does that win-to-loss ratio compare with the previous one? And then, I mean, you're just trading. You're not farting around picking your toenails. You're actually trading, so you're not wasting your time doing these. You're trying to build solid metrics so that you know whether your rules are going to work. And you have to do it over enough times that you're doing it within the chop, and you're doing it within the trends, and you're doing it within NFPs, and you're doing it within times when you're sick. You have to develop these metrics so that they're good over all emotional times and all economic times. Okay? You can't say you're a 60-40 trader if all you do is trade on a Tuesday, twice a month. You don't have enough data to support that. The folks that are out there doing education really don't stress this. And I think that if you're not consistent in that win-loss ratio, and the fact that I say 300 trades means absolutely nothing. You're going to make 300 trades anyway, so what difference does it make if you're calculating your ratios? It isn't like, oh, I got to calculate my ratios so I know what to do. That's not the way it works. You have to figure out what to do so that that's reflected in the ratio that's being thrown back at you. So you're not wasting any time. Jesus, these people that are teaching this stuff say, oh, you better get out there, trade for a few days, you get a win-to-loss ratio, you can, boom, 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 okay, you're all set, and here's what you can do. That isn't what you can do, because that's not a consistent ratio. So the key to the thing is to develop that consistent ratio, or to develop a ratio that's consistent, okay, a win-to-loss ratio. And you could say, well, how do I do that? Well, which is the topic of the video. You look at the overall picture of what you're trying to do as a Forex trader. And you build a framework around that. You create boundary conditions around this thing called currency trading. And so okay, here it is, boom, I've got currency trading. Well, what does that consist of? It consists of entry analysis, right? Position management, and exit methodology. That's your position framework. The life cycle of a currency position has entry analysis, position management, and exit methodology, okay? So within the framework, you've created a problem domain. What's the problem domain of a life cycle of a currency position? What's the problem domain? The problem domain is entry analysis, position management, and exit methodology, okay? And each one of those is a phase of that framework. There's 3 phases within the framework. This is something that I go over exhaustively in the course that I have. There's actually 3 courses, but it's really to pull those 3 things together and show what each one is, because each one of those phases has a problem domain in itself. Entry analysis. What's the problem domain? How do I successfully enter a position? Well, what is the definition of a successful entry? It's that you don't get stopped out in your entry phase. When do you transition? Do you know when you transition from the entry phase into the position management phase? Well, you're going to need to know that, because you're going to have to switch the rules, because the problem domain of the entry analysis phase is different than the problem domain of the position management phase. of the life cycle of a currency position framework. So the idea is the problem to solve in entry analysis is how to get to a profitable position so that you don't get stopped out. All right? So what's the problem there? Getting stopped out. If you can solve that problem consistently, the rest of the stuff goes together for you. And it will help you better understand how to look at the position management phase of that life cycle. What's the problem you're trying to solve there? What are the potential solutions in that area? I have 7 factors to consider in that position management phase of that life cycle that you really need to know the questions, and you need to be able to figure out the answers, and then you need to be able to put those answers into a solution set that's in a logical sequence. You can't just pick one of those and solve it, because the price may not be in that particular spot, or whatever you want to call it, that's the problem that you need to solve at that time. And so how do you become consistent in your trading? What's the result that you're looking for consistency? It's a consistent win-to-loss ratio excuse me, over a long period of time. And what's the best way to get that consistent ratio? Is don't get stopped out. So how do you solve that problem? How not to get stopped out? It's really, really, really simple. And so when I present that to somebody, I mean, you have to be in a context with me in order for me to say, well, this is how you do that. Well, the issue is, what kind of analysis do you need to do in order to have a higher probability that the trade will go into profit rather than it getting stopped out? I mean, how do you resolve that? So that's like a little exercise for you to do, is to just take these steps one at a time. If you're not having the success in your trading that you'd like to, why are you trying to trade all the way through the life cycle? If you were having trouble in your basketball game, you wouldn't go and practice the running and the dribbling and and all that other shit. What would you do? What's the point of playing basketball? It's to throw the ball and get it in the hoop. All the rest of the stuff is just supporting shit that gets you to a position where you can throw the ball and dunk it in the hoop. Why do you think most of the guys that are in the NBA, they don't play a lot of basketball? They're out in the backyard or in a sandlot court when it's raining out, shooting hoops. That's how you get in the NBA. Lee Trevino, the famous golfer, said, no matter what the weather is, no matter how tired I am, I don't care whether it's Christmas or my birthday, every day I go out and I hit 1,000 balls. Every day, 1,000 balls. So when I step up to the tee, I know where my ball's going to go. My opponents only think they know where the ball is going to go. That's consistently, that consistent application of the rules that he developed as to his swing and his stance and judging wind direction and all that other crap, that all goes together into a par score, right? What do you shoot? And when you know what you're shooting, you know what's going to happen. You're not thinking about that. So if you're trying to get more consistent with your trading, if you're having trouble being consistent or you're not getting the results that you need, don't trade. Forget about the trading. Solve the first problem in the position life cycle framework, which is entry analysis. And once you get that figured out, then you move into the position management. And once you get that figured out, and it connects well and hooks up well with the entry analysis, then you can go and look at exit methodology. And once you go through those 3 steps and solve them, you'll be a consistent trader. Now, you may need somebody to show you how to do that or walk you through it or buy a course or whatever. I mean, I don't know anybody who breaks this stuff down like I do because I'm an engineer. This is what I do. But that's what gets me to the point where I know what my consistency should be. And I know when I break those rules, and I know what the potential is for something happening bad. But I also, because I have this large view and I've broken these pieces up into individual units and solved them, I also know how to get out of the shit once I'm in there, or I just take the hit and get out because I know there's no way to get out of the shit. So how an experienced trader trades is going to be different than what somebody who's not having the success that they're having should be trading. So you can't have a successful trader that doesn't know how to teaching you how to fix your trading, because it doesn't work, because they don't know, because they didn't go through those steps. It's like a guy, I give this example all the time, a guy runs through a minefield and he gets to the other side and he jumps up and down and he says, "Follow me, I know how to get through this minefield." No, you don't, Slick. You don't know how to do that. You got through it, you got lucky. Now you're going to tell everybody else how to do it? I don't think so. Make your life easy in trading, because that's what I stress all the time. Trading is simple. It doesn't make it easy, but it does make it simple, right? And so you've got a framework. That framework consists of entry analysis, position management, and exit methodology. Break it down, solve the first part first, solve the second part, hook the second part to the first part, solve the third part, hook the third part to the second part, which is already hooked up to the first part, but make sure that the third part hooks up with the first part. In fact, when I start teaching, I teach the last part. That's how chess should be taught. And I've had videos about that. You go look at a video called, I don't know, Chess Theory and FOREX Trading, or whatever the name of the video is. And it shows Jose Capablanca, a grandmaster. When he taught chess, he put the 2 kings on and a couple of pawns and a bishop. And so he'd teach you how to checkmate the king with those pieces. Well, the whole point of the game is to checkmate the king. Why would you set all the pieces up on the board and go pawn to king 4, pawn to queen 4, and start teaching that shit when you don't even know why you're doing that? That was his premise. Start at the end and work your way to the front. And so start with a king and a couple of pawns and a bishop. Take the bishop off, put a knight on. Take the pawns off, put a bishop and a knight on. And work your way through it. And pretty soon you understand all the movements of the pieces, the values of the pieces, and what you're trying to do. Every time you're out there, what you're trying to do is checkmate the king. So if you look at the life cycle of a position within that framework of entry analysis, the position management, and the exit methodology, go to the exit methodology first and figure out how to get out of the trade successfully. Because the presupposition there is that you have a successful trade. That's what you want. You don't want an unsuccessful trade. You don't want to get stopped out. What do you need to do not to get stopped out? So that when you exit because you want to exit, not because you get stopped out, right? Okay. I hope that was helpful for you. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.